Today, we're taking a deep, fundamental look at the Timken Company, ticker symbol TKR. Timken is a more than 125-year-old industrial technology company that specializes in engineered bearings, motion products, and advanced mechanical systems. At first glance, TKR may not look like an exciting growth stock, but underneath the surface, the company is attempting to transform its portfolio, improve margins, increase exposure to higher growth industrial markets, and potentially grow adjusted earnings substantially through 2028. So the big question is, after the recent move in the stock, does TKR still have attractive long-term upside? Timken operates primarily through two major businesses, engineered bearings and industrial motion. Its products are used in demanding applications where reliability, efficiency, precision, and durability are extremely important. That includes aerospace and defense, power generation, electrification, automation, industrial equipment, rail, heavy-duty vehicles, and other specialized markets. This is important because Timken isn't simply selling commodity components. Many of its products are engineered into customer systems, which can create meaningful switching costs and long-term customer relationships. One of Timken's biggest strengths is its engineering expertise. The company has spent more than a century developing specialized knowledge around bearings, friction management, power transmission, motion control, and related technologies. In many industrial applications, reliability is far more important than simply buying the cheapest component. A failure can result in expensive downtime, maintenance costs, or safety concerns. That creates an opportunity for Timken to compete on performance and reliability rather than price alone. Its global manufacturing footprint and relationships with major industrial customers add another layer to that competitive position. Timken generated approximately $4.58 billion of sales in 2025, essentially flat compared with 2024. Full-year adjusted EPS was $5.33, while adjusted EBITDA was approximately $795.8 million. However, adjusted EBITDA margin declined to 17.4% from 18.5% a year earlier. So 2025 was not a perfect year. Revenue was basically stagnant, and profitability came under pressure. This is important because investors shouldn't evaluate TKR purely on its historical earnings. The investment thesis depends heavily on management successfully improving the company's margin structure going forward. The first quarter of 2026 provided a much more encouraging picture. Timken generated $1.23 billion of revenue, representing approximately 8% year-over-year growth. Organic sales growth was approximately 4.3%. Diluted EPS increased to $1.40 from $1.11, while adjusted EPS increased to $1.67 from $1.40. Adjusted EBITDA margin also improved to 18.8% from 18.2%. In other words, Timken wasn't simply growing revenue. It was also converting that growth into better profitability. Another important signal was management's decision to raise its 2026 outlook. Timken now expects full-year adjusted EPS of approximately $5.75 to $6.25, compared with the previous range of $5.50 to $6. The company also expects reported diluted EPS of approximately $4.70 to $5.20. This tells us management entered 2026 with enough confidence in demand and operational performance to increase its earnings expectations. This is where the TKR investment thesis becomes much more interesting. At its May 2026 Investor Day, Timken introduced its Elevate to Outperform strategy and established 2028 targets. The company is targeting total sales of approximately $5 billion to $5.2 billion, with organic revenue growth in the mid-single digits. More importantly, Timken is targeting adjusted EPS of approximately $8.50 by 2028. That's more than 55% above its 2025 adjusted EPS of $5.33. The most important part of the 2028 strategy may not actually be revenue growth. It is margin expansion. Timken wants industrial motion adjusted EBITDA margins to reach 25% to 27% by 2028, compared with 19% in 2025. For engineered bearings, The company is targeting a 21% to 23% adjusted EBITDA margin versus 18.9% in 2025. If management can achieve these targets, Timken could generate significantly more earnings even without explosive revenue growth. Management is also reshaping the portfolio. Timken announced the acquisition of Bijur Delimon, which expands its automated lubrication capabilities in areas such as rail, power generation, and mining. At the same time, Timken announced plans to sell its belts business. The logic is straightforward. Allocate more capital toward businesses with stronger growth and margin potential while reducing exposure to less attractive assets. If executed properly, this portfolio optimization could improve the overall quality of the company. Industrial automation is another potentially important long-term opportunity. Timken's motion control portfolio includes products used in automation and advanced machinery. The broader trend toward factory automation, robotics, electrification, and more sophisticated industrial equipment can create demand for precision motion components. Investors should not treat robotics as guaranteed revenue growth for Timken, but the company's existing technologies give it exposure to several of the underlying industrial trends. Aerospace is another attractive part of the portfolio. Aircraft require highly engineered bearings and motion components that must meet demanding performance and reliability standards. Increasing commercial aircraft production and long-term aerospace demand can therefore support Timken's higher value products. Defense spending can provide another source of demand. The important point is that aerospace tends to involve specialized products and qualification requirements, which can create barriers to entry. Timken also has exposure to power generation and electrification. As the global economy invests in electricity infrastructure, industrial equipment, renewable generation, and more efficient machinery, demand for bearings and motion products can increase. These markets can also benefit from long-term replacement cycles because industrial equipment requires maintenance and replacement components over time. For industrial companies, earnings alone aren't enough. We also want to see whether profits translate into cash. In 2025, Timken generated approximately $554 million of operating cash flow and approximately $406 million of free cash flow. That gives the company financial flexibility to invest in the business, pay dividends, repurchase shares, and pursue acquisitions. Timken ended the first quarter of 2026 with net debt to adjusted EBITDA of approximately 2.1 times. That's not an insignificant level of leverage, but it is also not necessarily excessive for a mature industrial company with meaningful cash generation. Management's ability to generate cash while reducing or controlling leverage will be important, particularly if the company continues making acquisitions. Timken has a long history of returning cash to shareholders. In May 2026, the company increased its quarterly dividend to 36 cents per share, marking its 13th consecutive year of dividend increases. At $1.40 annualized, the dividend yield is around 1% at recent prices. This isn't a high-yield stock, but the dividend provides an additional component of shareholder returns, while the primary investment thesis remains earnings and valuation growth. Timken also has an important capital return lever through share repurchases. In February 2026, the board authorized a new program allowing the company to purchase up to 10 million shares through February 2031. If management repurchases shares at attractive valuations and funds those purchases with sustainable free cash flow, a lower share count can provide additional support to earnings per share. Now let's discuss valuation. The recent market price is around the low $130s, although the stock price can move significantly from day to day. At approximately $130, TKR is trading at a relatively high multiple of current reported earnings, so investors should not view it as an obvious deep value stock. The more interesting valuation argument is based on future earnings. If Timken approaches its approximately $8.50 adjusted EPS target for 2028, today's valuation could look much more reasonable if the market continues assigning the company a quality industrial multiple. Let's use a simple scenario analysis. If Timken reaches approximately $8.50 adjusted EPS in 2028, a 15 times earnings multiple would imply roughly $128 per share. At 18 times earnings, the valuation would be approximately $153. At 20 times earnings, it would be approximately $170. At 22 times earnings, it would be approximately $187. These are not price predictions. They are valuation scenarios showing how much the eventual multiple matters. The key takeaway is that earnings growth alone does not guarantee a higher stock price if the valuation multiple contracts. In the bull case, Timken successfully executes its 2028 strategy. Revenue grows at the targeted mid-single-digit organic rate. Industrial motion margins move toward 25% to 27%. Engineered bearings margins improve toward 21% to 23%. Acquisitions contribute additional growth, and adjusted EPS approaches or exceeds $8.50. If investors then value TKR at around 20 to 22 times earnings, the stock could potentially trade in the $170 to $190 range based on that future earnings framework. Again, this is a scenario, not a guaranteed target. In my base case, Timken makes meaningful progress but doesn't perfectly achieve every 2028 target. Suppose adjusted EPS eventually reaches around $7.50 to $8, and the market applies a 17 to 19 times multiple. That would produce a broad valuation range of approximately $128 to $152. Under this scenario, the stock could generate moderate returns, but the upside would depend heavily on entry price and the pace of earnings growth. The bear case is equally important. Timken operates in cyclical industrial markets, so a global manufacturing slowdown could hurt volumes. Raw material inflation, tariffs, currency movements, higher labor costs, weak automotive demand, aerospace disruptions, or weaker industrial spending could pressure margins. If earnings fail to reach management's targets and the market assigns a lower multiple, TKR could remain under pressure for an extended period. This is why investors should not simply assume the $8.50 2028 EPS target will automatically happen. The biggest risks are cyclical demand, execution risk, acquisition integration, leverage, tariffs, and geopolitical uncertainty. Timken itself highlights risks including changes in customer demand, raw material and energy costs, tariffs, foreign exchange, interest rates, debt obligations, acquisitions, and global economic conditions. For an international industrial company, these risks are very real. If you're following TKR, I would focus on 5 numbers. First, organic sales growth. Second, industrial motion margin. Third, engineered bearings margin. Fourth, free cash flow. And fifth, net debt relative to EBITDA. If revenue continues growing while margins expand and leverage remains controlled, the fundamental thesis becomes stronger. But if revenue slows and margins fail to improve, the 2028 EPS target becomes much harder to justify. Based purely on the fundamentals, I would describe Timken as a high-quality industrial company with a credible margin expansion opportunity, but not a risk-free bargain. The business quality is attractive because of its engineering expertise, diversified industrial exposure, customer relationships, and long operating history. The 2028 strategy provides a clear roadmap, but investors are paying for some of that expected improvement today. So, is TKR a buy? My conclusion is that Timken is more interesting as a long-term earnings growth and margin expansion story than as a simple dividend play. The strongest part of the thesis is the potential move from approximately $5.33 of adjusted EPS in 2025 toward approximately $8.50 by 2028. The biggest question is execution. If Timken delivers the targeted margin improvements and earnings growth, the stock could have meaningful long-term upside. If the company misses those targets, the current valuation becomes much less attractive. At current levels, I would classify TKR as a moderately bullish, execution-dependent industrial stock, rather than an obvious deep value opportunity. Investors should pay close attention to the next several earnings reports to determine whether the 2028 strategy is actually translating into higher organic growth, stronger margins, and stronger free cash flow. What do you think about TKR? Do you believe Timken can reach approximately $8.50 in adjusted EPS by 2028? And could the stock eventually reach $170, $180, or even $190? Let me know your target in the comments. And if you found this analysis useful, make sure to like the video, subscribe to the channel, and turn on notifications for more detailed stock market analysis.